It was another volatile session on Wall Street. However, we didn't have the disastrous selling that we saw yesterday. We did see a chance at a rebound early in the day, but as the day unfolded, unfortunately, the S&P 500 and Dow Jones each gave up their gains and actually closed slightly in the red. The Nasdaq was able to hang on to just a little bit of gains, but just gives you that impression that we're not quite done with this move that we've been seeing here recently. And of course, tomorrow we do have the Federal Reserve meeting. So we'll take a look at all the charts, see what it means for our posture. Then we'll get into a trade application example where I wanted to focus on a technique of selling puts, which tends to be at an advantage when implied volatility is high like it is now, if you expect markets to stabilize in coming months. And in this case, with this consumer staples company, I think that could easily happen. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 21st, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down into the description area to sign up for our email distribution list. We're also heavy users of Twitter. If you're not following me yet, I would encourage you to do so by going to my Twitter account at Brandon Van Zee and clicking the follow button. And we really appreciate those of you that click like and retweet on those tweets as well. And then last but not least, we do have a presence over on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And before we get into the charts, let's kind of deviate off course here briefly. I wanted to show you that things did not end very well for the markets despite what appears to be a flat session. We actually had some worse market breadth underneath the surface. You can see up here I've got the S&P 500 watch list pulled up, and this area of the Thinkorswim platform gives us a chance to see which stocks are advancing and which stocks are declining within any given watch list that you have. And you'll notice here that out of the 500 stocks in the S&P 500, 333 of them actually closed in the red today. Remember, normally when you have a flat session like we had here today, the expectation is you'd have a pretty close split between the advancers and decliners, you know, around 250 for each of those areas. And so you can see an obvious tilt towards the red side of the equation here in today's case. So what that tends to mean in my expectations is that the larger companies probably held up a little bit better than the smaller companies within the S&P 500. Remember, the S&P 500 is a market cap-weighted index, and so stocks like Microsoft and Apple have a much bigger sway than so many of the other companies that are out there. So for instance, here's Apple. And Apple was one of the 168 companies in the green, but it carries more than just a 1 out of 500 weight is the way that you can kind of think about that. It's you know, obviously about you know, 5% of the weighting or something along those lines. So it's a big aspect of it. Whereas some of these other companies that you see listed here probably not going to have as big of an impact. I don't know. Let's just try to find one that might be a little bit smaller. Here's Bank of New York as an example. It's going to be much less important to the overall close of the S&P 500 than something like Apple. And you can see there are lots and lots of those red bars up above here. Some of the bigger red bars, at least on the first rung, this is all in alphabetical order. So these are some of the ticker symbols that are, you know, up there in the A's, B's, and C's. But you can see here Activision Blizzard was one of today's worst performers. I heard there's some nefarious things going on over at that company, allegedly, and that stock has really suffered the last couple of days, that video game company. I did notice that I think it ended up with a oversold cluster signal, however, so maybe there's an opportunity for it to kind of stabilize here. So that was one of the bigger down movers there in that first grouping. Here was another big down mover, which was Carrier Global, so heating and air conditioning type of a company there. It was down about 4% here today. Some other big losers over here. Disney kind of came out of nowhere and had a nasty end to the day. It was down 4% when it was all said and done. Discovery was down 3%. And that's the other class share of Discovery right there. See a couple of other big bars down below here. LVS, so that's Las Vegas Sands, Remember, there's not a whole lot of Las Vegas in Las Vegas Sands anymore, as they're kind of moving out of Vegas, and most of their properties in the future are expected to be in Macau and then also in Singapore. And most of you are aware of what's happening over in China, and of course Macau being the legal gambling market within China. There's been a lot of concern there lately about regulations and perhaps whether some of the foreign operators will get their licenses renewed. So we'll all find that out here in the coming year or so. But there's a lot of controversy around that right now, given a lot of the actions the Chinese government has been making here over the past couple of months for a lot of different industries, not just gambling. But once again, Las Vegas Sands struggling here today. And then we also had NOV, which is an oil and gas company, struggling on the downside. Some of the bigger movers on the top side in terms of the green bars that you see up there. Here was one of our bigger movers. AutoZone was up nicely here today. It looks like it was up about 3.5%. We also saw that ConocoPhillips was up 4%. Some of you saw me tweeting about that last night. They raised their dividend by 7% and then also announced a very large $9.5 billion acquisition of assets in the Permian. I think it was from Royal Dutch Shell that's selling those assets. So perhaps market participants viewing that as a fire sale of sorts that Conoco was on the advantageous side of. To my knowledge, Royal Dutch Shell was trying to get out of there to reduce their carbon footprint, and so they might have been willing to let go of those assets at a cheaper price than maybe what they're worth, and maybe Conoco looked at that as an opportunity there. We also saw that DFS, so this is Discover Financial, did reasonably well today. It was up about 2%. Some of you will recall Discover Financial was the stock that I bought those long call leaps on in the bottom of the crisis in April of 2020 that went on to tremendous gains along the way. Those of you that took that trade might still be in those leaps because they still haven't expired yet, but that's been an amazing move from the lows in March and April of 2020 for Discover to where they're at here today, up at $122 per share. And then down below I see another green one that's kind of emerging, and that's Moderna. That's been one of our most successful stocks in the S&P 500 in the year 2021, of course, directly involved with the vaccinations for the coronavirus. So a lot of timely moves there, so to speak, in terms of some of the news stories that have been affecting the markets here more recently. So in other words, we had a flat market today, but I think it actually tilted a little bit worse than it looked on paper if you were to kind of lift up the hood and look underneath a little bit here at some of the market breadth. Let's go ahead and pop on over here to our charts now. Take a look at chart 4B here. And as you can see, we have red backgrounds on all of our charts as it stands. A reminder that the chart in the upper left is the S&P 500. The chart in the upper right is the Dow Jones Industrial Average. The chart in the lower left is the NASDAQ Composite, and the Russell 2000 is our last one in the lower right there. So as I've been mentioning the last several sessions that I've been doing this presentation for you guys, to me, the laggard of our group currently is the Dow Jones Industrial Average, and our leader has been the NASDAQ Composite. And so far, what I've seen, despite yesterday's rug pull type of a day where we were down basically 2% in most of the market averages, despite that big controversial type of a day that we saw there, I still think that holds. As you can see here, none of the charts have a green background color. So all of these charts do have a bearish posture of some sort. And when I'm referencing the bearish posture, I'm referencing the intermediate line there. I know a lot of you are new, and so I like to speak to those of you that are new. As those of you that have been around long enough, you'll get a chance to, of course, get David and I's more in-depth review and analysis of the markets within our premium classes every single day here at Market Scholars. But for those of you that are new and are just finding yourself here with us at Market Scholars here this week, perhaps due to the overall market volatility, and you're kind of surfing around YouTube looking for videos to watch, What we do in this video is we use this technical indicator that you see at the bottom of these 4 charts called the Market Forecast Technical Indicator that you can find over on the Thinkorswim platform. And then we use a lot of customizations within our ThinkScripts that we offer to our premium members to be able to kind of evaluate the information a little bit better through color coding and different things like that. So when we are looking at this and asking ourselves what is our posture on the markets, unless you hear David or I specify otherwise, what we are referencing is the intermediate line on the market forecast. And with those 3 different colored lines that you see down below, the intermediate line is the green one. Again, it matches the label where it actually reads intermediate line right there. And if the intermediate line is falling between 80 and 20, as it is with all of our charts, actually, I take that back. The Dow Jones Industrial Average is actually below 20. All the others are falling somewhere between 80 and 20. Then we distinguish that by either strongly bearish or weakly bearish. So all of them would be bearish of some sort. But if the green line has fallen below the chart's 50th percentile, then we would equate that to a strongly bearish posture. And you'll notice here that 3 out of our 4 charts do have that dark pink background color signifying strongly bearish posture at this moment in time. Today, the Russell 2000 joined the S&P 500 and Dow Jones with that. So in other words, we have new information as of today. The Russell 2000 saw its green line fall just slightly below the 50th percentile there. So 3 out of our 4 charts do have strongly bearish intermediate postures at this moment in time according to the Market Forecast Technical Indicator. But of those 3, it has been the Dow Jones Industrial Average that has had that strongly bearish posture the longest. Remember, we've already had a strongly bearish posture on the Dow Jones Industrial Average well before yesterday's terrible event. We've been strongly bearish on the Dow since September 10th, and we've had a weekly bearish posture on the Dow since September 3rd. So it continues to be very heavy, very weak there on the Dow Jones Industrial Average. On the flip side of that, why I say that the NASDAQ Composite is our leader is it's the only one of the 4 that does not have the strongly bearish posture. Notice the background color for the NASDAQ is that light pink color there. So we have not seen the green line cross below the 50th percentile yet, and therefore if you're looking for relative strength out there and you still want to be committed to the bullish side of the market, then a lot of those NASDAQ composite stocks might be a place where you can look for that. You'll also notice that it appears that the NASDAQ is trading closer to its 30-day moving average than a lot of these other indices here. So there's just more selling pressure that you can see with those others. But I think that the key takeaway is we do have bearish conditions here, right? That does not mean necessarily that we are heading into a bear market, but our posture is currently bearish. And you can kind of get a sense by looking at the color coding of the charts how often postures change, because it's not as though we couldn't change back to a bullish posture in just a couple of weeks. That would be entirely possible. You'll notice here as an example on the NASDAQ Composite down below, we've been mostly bullish during the last 3 months. That's the green shaded background color parts there. But we did have 2 different instances along the way before this current move where we have gone to that bearish posture. It immediately corrected itself, so it was a very fleeting bearish posture. But nonetheless, it's just a reminder that these postures do change, and so that's why we come to you as often as we do here in these videos to kind of talk through where things currently stand. So if you're out there looking for more bearish types of trades, then the Dow Jones types of stocks might be the good place to find those. If you're trying to kind of be a little bit more counter trend, so to speak, and you're willing to be bullish when the rest of the market is getting more bearish, then you might start focusing in on some of those more relatively strong NASDAQ composite stocks that are out there. Let's go ahead and take a look here at our 3 green arrows chart now. You can see this is chart 4D. And as we're looking at this here, you'll notice that we only have one chart that does not have 3 red arrows. So on this chart, the background colors will tell us whether we have 3 red arrows, in which case the background color will be pink. Otherwise, it'll tell us if we have 3 green arrows, in which case the color the color background would be green. I don't have any current examples of that, but back here is a past example of it. Otherwise, if the background color is white, then that means there's a mix of green and red arrows. And that's one more way for us to use our eyes to identify through a color coding system who our leaders and laggards are. In this case, you'll notice that the NASDAQ composite does have a green arrow here currently on the stochastic. So while it does have its other 2 indicators, the moving average and the MACD, giving us a more bearish view with the 2 red arrows there, it's the only one of these 4 charts on the board that has any green arrows. So it's slightly more attractive from a relative strength perspective than these other charts that are on the board here. Now, one thing I didn't mention, I should go back just a second here to show you on chart 4B, the Dow Jones is getting really close to an oversold cluster signal. So remember, sometimes things can get so bad they become good. And what I mean by that is if the selling pressure is so extreme that everybody's on the same side of the trade, usually the market does its best to aggravate as many people as possible. So if we see further selling in the Dow to the point where all 3 of these colored lines end up in the low reversal zone on the market forecast below 20, and we get those little green dots to start showing up, that might be an opportunity to take kind of a reversal to the mean type of a trade, but we're not quite there yet. You can see the blue and the red line. If I were to right click here and go to maximize the sell, you can see that the blue and the red lines on the market forecast are not quite below 20 the way that the green line here currently is. So it could happen within the next couple of days. As I mentioned in the intro, we've got an important day tomorrow with our FOMC meeting. So who knows what comes out of that. Sometimes it feels like when Jay Powell opens his mouth, markets just start selling off. It's not always the case, but it kind of feels like that we're in one of those precarious moments right now where he's got to kind of word his commentary very carefully. Otherwise, the market might take it the wrong way. And there are some people out there that think that he might start pushing for a bit of tapering. And if that happens, well, we're kind of in this precarious moment here where we're grappling with the coronavirus and we're grappling with what's happening in China. You know, markets might take that the wrong way. So prepare yourself. We're in a little bit of a dicier market right now than we had been. And of course, we've been upfront with you guys on that. You guys know from a seasonality perspective that September and October tend to be the months where there are more nerves in the air because market participants remember that those are the months that we've historically had some stock market crashes throughout time. And so we just got to be a little bit careful where you might end up having more of a domino effect where one thing leads to another and sentiment starts, pushing stocks to levels they probably don't deserve to trade at because for the most part, the economy is actually pretty strong here in the United States. It's just a matter of whether those gains and those good vibes have already been kind of baked into the cake, so to speak, as we've had the good fortune of having our stock market go up for 7 or 8 months in a row prior to the month of September that we're dealing with right now. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support us here. Remember that this is a completely free video. David and I don't make a single penny on doing these videos, and so we do them completely on a voluntary basis. And we hope that we have a positive impact on doing that with you guys, and hopefully you guys get value out of listening to David and I's analysis along the way. If you do, we ask one simple thing out of you. Click like for us on Twitter. And you can see that the last time around that I did the video, 99 of you clicked like. So I just missed my goal of 100 likes by one single like. Somebody was holding out on me out there. And just a heads up, I won't be doing the video on Thursday. I've got a couple of other things going on. But do your best to try to support the project because, again, we do this on a voluntary basis. And we want to make sure that we're not wasting your time. And we also want to make sure you're not wasting ours. So if we can both work together, you guys can can promote our services a little bit along the way. We'll give up about 3 hours of our day to do these videos because it's not just a snap of the fingers, it's actually a pretty big production to get everything involved with these videos. So since we don't make any money off of them, we have to really carefully consider whether they're worth doing or not because they do soak up a lot of our time. So thank you to those of you that do support this project and do help us along there on Twitter. Please keep that up. Also, while we're over here, just a quick peek at the sector selector. Now, a reminder, I put these sector selectors together on Friday evenings, and so normally that's not that big of a deal. I oftentimes show it to you guys here in these Tuesday videos because we're only a couple of days removed from the Friday night post. But considering what happened here yesterday, even a 2-day difference can make an impact. So just a friendly reminder that this is as of Friday night. It does not include any activity that might have affected it here yesterday or today. So what we saw as of Friday night, healthcare was able to remain #1 on the overall rankings. Healthcare has been one of those sweet spots here where you're looking for healthy market trends. It has been able to kind of get past a lot of the other controversial areas of the market. Part of that is because they are part of the solution, right? With the coronavirus and everything, there's a lot more diagnostics and testing. And of course, the vaccine makers like Moderna and BioNTech and Pfizer have done really well this year. So all of that has kind of been wrapped together in a more beneficial market environment for the healthcare companies. Information technology stayed #2 and real estate stayed #3. So our top 3 really stayed exactly the same. Energy did have a nice pop up to #4, but I have a feeling that's going to be awfully fleeting. I don't know that to be a fact, but generally speaking, energy does make some big movements. You can see back here it dropped like a rock, and up here it went up very quickly. So it, more than a lot of these other sectors, does have the ability to move up and down this graphic very quickly, and it is highly cyclical. And so with the stock market being on a more of a risk-off mindset this particular week since this post on Friday, I'd venture to guess that if I were a betting man, I would suggest that energy is probably going to fall from the #4 slot by the time I do this graphic again this upcoming Friday. On the bottom side of the graphic, you will see materials, utilities, and consumer staples all move down in their rankings. Now, of those, materials is the most cyclical. And, similar story with energy. I would suggest that materials probably isn't going to be able to make too much of an improvement this coming Friday, but I would not be surprised at all if we saw utilities and consumer staples advance just a little bit, because although those areas have fallen a little bit, maybe they haven't fallen as much, right? That's kind of where you hunker down in some of the more defensive areas when times get tough. In fact, over here on Twitter last night, I was posting this right here. So yesterday was quite the day. 90% of the S&P 500 was down yesterday. And so there was only 10% of the market, only 50 out of 500 that actually closed in the green. And one thing that did catch my eye is that airlines, for some strange reason, and utilities both stood out to me. Utilities not so much because, again, their defensive nature attracts money when there is more chaos. And you can kind of see, like, as you look at this graphic here, a number of those utilities, CMS and WEC and Public Service Group and Alliant and Evergy and Eversource and NextEra and Atmos, etc. So anyway, the utilities, I think, have a decent chance to be able to kind of put that together in terms of advancing on the sector selector this upcoming Friday. Also, while we're over here on Twitter, thank you to Claire. She's one of our premium market scholars. She posted this here yesterday showing that we're currently in the midst of 99 sold put wins in a row, and that stretches back 19 months at this point. So if you're curious of some of the trades that we've taken, remember some of these are going to be the sold puts that I've showed you guys here in this market outlook video as part of my trade application example at the end of the video. All of the other trades would be the sold puts that I've taken for my options for long-term investors classes here as premium classes at Market Scholars that I teach on Monday afternoon. So if you're curious of some of those trades that we've taken over the last 19 months, you can check out that graphic, and thank you to Claire for putting that together. So we're a magical just one win away from 100 in a row, which would be a really neat milestone and achievement there for us. And that's a little bit of a foreshadowing, because our trade application example, as I mentioned in the intro, is going to be selling a put here today. So we'll get into that here in just a little bit. Before we do that, let's go ahead and do a little bit more analysis within the charts by doing some 12 grid analysis, starting with chart 5A. And for those of you that are newer, be aware that the background colors of these charts will tell us whether the current intermediate posture is bullish or bearish. Naturally, the bullish postures will be the ones with the green backgrounds, and then the bearish intermediate postures using that market forecast technical indicator will be the ones with the pink backgrounds. So as we're looking at this first set of 12 grids, a reminder that this asset class view is going to oftentimes come with lots of green and lots of red. It's not going to be a clean sweep like oftentimes we see with the sectors, because this is going to be a wide variety of asset classes here, from currencies to commodities to stocks and fixed income, etc. So anyway, let's see what we can discover here by doing a little bit of analysis on the grid here. And you can see that one of the areas that seems to have benefited here more recently is the bond market, at least the U.S. government bond market. Off on the left-hand side here, you can see that TLT does have a green background color, where we are trading somewhat close to 3-month highs. Those of you that have not attended my top-down trend trading class here recently on Mondays, be aware that I do have a slight rule change that we discussed just yesterday in class. If you're interested in watching that recording there, it is posted for those of you that are premium members, where we are going to introduce a few ETFs on occasion to what we had traditionally done, which was individual stocks there, and it gives us an opportunity to kind of wade into a couple of other areas like cryptocurrencies or like fixed income or commodities or what have you. So anyway, we had a conversation about how U.S. Treasury bonds have been holding up reasonably well as a relative safe haven, at least in the short term, while the stock market has been in a little bit more of a foul mood. And you can kind of see that play out here with TLT itself kind of holding very nicely above its rising 30-day moving average. Notice that the US dollar is kind of giving us the same impression. It is also trading with a strongly bullish posture according to the market forecast, and we are trading above a rising moving average, which is distinguished there by that green moving average itself. So those are two areas that seem to be benefiting while the stock market itself is suffering. In terms of some of the more risky areas, be aware that Bitcoin has started to really fall off of the map here, and that's a little bit disappointing. I was gaining more bullishness on Bitcoin during this era right here, and I think as of today, my mindset has to change, right? It doesn't do any good to keep on, being bullish on something that is breaking down if you're looking at it as a trade rather than an investment. Now, some people are just going to buy Bitcoin and hold it for life or whatever, right? So that's a different mindset. But if you're just trying to read the charts, then I think, we did see some important information here in the last couple of days on Bitcoin as we broke down significantly below that moving average. Remember, sometimes people think that Bitcoin can be viewed as a safe haven asset, somewhat similar to the way that gold is sometimes perceived. But I think right now Bitcoin seems to still be a risk-related asset. It is a speculative asset. It's one that's done tremendously well over the years, but has come with a lot of volatility with that. So right now, I think it's a more cautionary time around Bitcoin as we were not able to hold that 30-day moving average. So be a little bit more cautious around that one now, and maybe wait for a bounce to see if one can happen there. In terms of gold, I mentioned that a moment ago. Sometimes that benefits as a safe haven type of a status asset, and you did see that kind of play out the last couple of days. Notice that gold was up 2 days in a row when the S&P 500 was down 2 days in a row. And we kind of had differences in the US dollar as well. Remember, sometimes gold gets driven around by whatever happens with the dollar. When the dollar goes down, gold goes up, or vice versa. Well, that doesn't really describe what's happened here either, because yes, it's true, yesterday the dollar was up, today the dollar was down, but gold went up both days. So I think gold is benefiting right now, as being perceived as a bit more of a safe haven asset. And remember, I've got that iron condor going right now on gold for this market outlook presentation, and I kind of like where we stand right now with that, quite frankly. We're trading basically in the middle of the range of the last 3 months here on gold, as you can see right now. Oil was down a little bit today, but it remains above its rising moving average. So I still think it's got some merit there. And then you can see the top rung is red across the board. We do have a light pink shading on foreign developed stocks, so perhaps Europe, Australia, Japan doing a little bit better than other parts of the world, like China, for instance, that seems to be in the news every day. Let's go ahead and take a quick peek here at our 12 grid for the US sectors. This is the market cap weighted version of it. And you can see that there's only one sector left in the green, and lo and behold, it's the one that I showed you before that was #1 on the sector selector. And remember, I'm actually using slightly different data points when I'm constructing the sector selector, because that's an equal weighted approach. This is a market cap weighted approach here, but it kind of confirms the same thing, which is healthcare is one of the leading areas of the market right now. Now, it's not to say that it looks great, right? I'm saying on a relative basis, it is a leader compared to these other sectors that are out there, but it's got its own problems that it needs to work with. So despite having that light green background color telling us that we have a weekly bullish posture, it is now trading below its falling moving average if you're looking at XLV here. So it's not all good out there. It's got work to do. And I think, you know, if you're looking to be more counter trend in your mindset and go bullish while the rest of the market is going to go bearish, then healthcare is going to be the area we're going to find some of that relative strength. In fact, we bought a healthcare company yesterday in my top-down trend trading class that just hit a new all-time high within the last week. So there are definitely some strong trends within healthcare if you dig deep enough, even if the overall sector is starting to show a little bit of wear and tear up at the top. All of the rest of the charts are red. You know, we've got energy and discretionary with kind of that light red, so it's telling us that they're weakly bearish. All the rest are strongly bearish, so not a great look out there after yesterday's significant selling in the stock market. You will notice that these two charts in the middle are somewhat interesting in that the industrials and the materials, which are some of the most cyclical, kind of dollar sensitive areas of our market, they both have these oversold cluster signals here with these green dots. So if you're ever looking at my charts and you see those green dots appear, what that effectively means is if I were to right click and go to maximize sell, you can kind of see down below, that's where all of those colored lines are together, the blue, the red, and the green in the low reversal zone. So we do have two straight oversold cluster signals here on materials, and it's approximately at the same area where we bounced on materials back here in mid-July, where we also received an oversold cluster signal right before we went on an epic rip higher. Is that what's in store here? I have my doubts. I do think that there's a decent chance that we have a little reversion to the mean, but I'm kind of going into the fall here with the expectation that September and October are going to be a little bit more difficult. I do expect the markets to rally into the end of the year, so I do think that November and December are going to be a little bit better, but you know, we might get a little bit of a bounce here on XLB. I would just be very surprised if it turned out to be like this one back here where you ripped straight through that moving average. This time, I would be surprised if it even touched the moving average, let alone go through it. So we'll all find out together, but just be a little bit more cautious because I think the market tone in general right now is much more negative than it was back here in mid-July. So I don't think that really helps those of you that want to try to play that one aggressively to the upside as a counter trend type of a trade. All right, let's get into our trade application example. And for that, I'm going to come on over here to chart 2A, which is the dividend stair step 1 grid. This is the chart that I use in my dividend growth investing class on Tuesday mornings, and also my options for long-term investors class on Monday afternoon that I addressed before with that tweet about 99 in a row. And so how we kind of use this is I'm going to pull up chart or ticker symbol CLX. This is Clorox, obviously well known, especially here in the United States. Purveyor of bleach and garbage bags and campfire coals. Some of you that are Kingsford fans might know that, and so they do a lot of different things. I think they also own Burt's Bees, and they have a lot of smaller brands, but obviously a well-known company here in the United States. Anyway, they are also a dividend aristocrat. In other words, they are a company within the S&P 500 that has raised their dividends for more than 25 years in a row or more. So we kind of give them a little bit of extra credit in my longer term classes because it gives you a sense of the quality nature of the business if they've been able to accomplish that very rare feat of raising dividends for at least a quarter of a century. And so when we are looking at this chart, the blue portion of the chart is where we would view this stock as attractive. The orange portion of the chart is where we view the stock as a bit overvalued. The white part in between is where we would consider that to be neutral. And all of this is based off of the average high yield philosophy and the average low yield philosophy. And it's something that kind of drives our decision making within those two classes that I mentioned where I teach here at Market Scholars. And so what caught my eye with Clorox in this particular case is that it has a little green dot showing up here today, and it's now down here in the white zone. It's kind of similar to this setup over here on August 2nd. Remember, this is a 10-year weekly candle chart. And these blue and these orange zones change for every single stock because every single stock has a different yield history. So these are living, breathing numbers and levels that do change throughout time. Well, anyway, Clorox was kind of the poster child of the coronavirus era, as a lot of people initially thought that a way to avoid the coronavirus was to wipe down all of their groceries and countertops and everything with those Clorox wipes. And of course, you couldn't find them anywhere. They were sold out for months. And so the stock really responded positively to that. Well, ever since topping out at 240 effectively here, it has been in a one-way trajectory down. And of course, a reminder, we would not have been buying this here in the orange zone because we would have known it was considered to be overvalued. Well, it's fallen so violently that it is now down here in the white zone again. So it's not quite to the blue zone where we'd feel comfortable buying it outright like we would have back here when it was touching the blue zone, and then back here, and back here, and then back here when it was in the blue zone. But it's at least approaching the blue zone where it sets up the possibility of selling a put at around that level. And so what a put sell does is it puts you on the hook for being willing to buy 100 shares of that stock at the strike price if the stock continues to fall to that level. So what I did for today's trade application, remember the trade was already done about a half an hour before the market closed, and I already sent out all of that trade information to those of you that are premium members, so that way it gives you an extra half an hour to consider the trade prior to everybody else watching the free video at night. But anyway, you can get the details of that trade in the Telegram there. But what I opted to do was selling the November 140 strike put on Clorox. I was able to get close to 1% return on risk, which is what we typically shoot for with those trades where we go between 20 and 60 days until expiration, but it was just under that. This one was a little bit more challenging because it has $5 between its strike prices. So I had to decide, do I want to sell the 145s or do I want to sell the 140s? The 145s would have been well over 1% return on risk, so a juicier premium and opportunity to take in. But, in this more precarious market environment where we could very well have choppiness in the next couple of months, I opted to go a little bit more conservative on this one. And by selling the 140s, I am in the blue zone. If I would have sold the 145s, I'd still be here in the white zone. So in an ideal world, I wish I could have sold like the 142s or 141s, but they didn't exist. As I mentioned before, this trade's $5 wide, not $1 wide. So in this case, that's what I opted to do. A very high quality dividend growth company that's raised its dividends each year for over a quarter of a century. We have signs of oversold conditions here on a weekly candle chart according to the market forecast. That's what that little green dot suggests. And we are now back in a more appropriate valuation here in the white neutral zone compared to all these overvalued valuations that we had in the orange zone. And by selling a put out in November, we are opening ourselves up to the possibility of being put 100 shares of this high quality stock at 140. And you'll notice if you kind of use my crosshairs towards the left, that 140 happens to be at the tippy tops of these resistance areas over here. So from a multi-year technical analysis perspective, you might also have that possibility of old resistance becoming new support right around 140 as well. Okay, so that's what I had for you here tonight. Another exciting day in the market. We'll see what tomorrow has in store with Jay Powell and company. Again, I won't be doing the video on Thursday, but as far as I know, David will probably be back with you here either tomorrow or on Friday or something. So stay tuned, and if you get value out of these videos, again, we ask one simple thing out of you, and it's to take 5 seconds out of your time. It's not to give us a big payment or anything along those lines, just simply to help support us, to let us know that it's worth our effort to do these videos for you as often as possible, to hopefully be somebody to lean upon in the more difficult days like we saw here yesterday. And who knows what we have in store for us going forward. So if you got value out of the video, that's one thing that I ask out of you. Just simply click like for me there on Twitter. Thank you so much. I'll look forward to seeing you next week. Best of success with your trades and your investments. Goodbye for now.